In September 2019, Peloton went public at $29 a share on the NASDAQ. The pitch was precise. Sell a $2,500 stationary bike, then charge $39 a month for the live instructor subscription that made the bike worth owning. The hardware got you in the door. The subscription was the business. By January 2021, the stock had climbed above $167. The implied market capitalization crossed $50 billion. Peloton had sold more connected fitness products in the prior 12 months than in its entire pre-pandemic history. Revenue for fiscal year 2021 came in at $4.02 billion, more than double the $1.83 billion reported the year before. The obvious reading writes itself. COVID locked people at home, people bought Pelotons, then they went back to the gym. That reading is technically accurate. It is also incomplete. What the quarterly SEC filings show is something harder to dismiss. Peloton's model required hardware sales to function. Every new connected fitness subscriber began as a hardware buyer. The IPO prospectus, filed with the SEC in August 2019, had already disclosed that the company had never been profitable. A net loss of approximately $195.6 million in fiscal year 2019, on revenue of approximately $915 million. The business was built on the assumption that subscription revenue would eventually close that gap. When hardware sales grew at over 100% in a single fiscal year, the monthly churn rate against that expanding subscriber base looked manageable. According to Peloton's fiscal 2021 annual report filed with the SEC, average net monthly connected fitness churn was approximately 0.6%. 73%. That is roughly 9% annual churn. The subscriber base was only growing because the pandemic was forcing hardware conversions at scale. A subscriber who paid $2,500 for a bike was presumed to be highly retained. The hardware investment created switching costs, but switching costs and active retention are not the same thing. A subscriber who paid $2,500 and stopped using the bike would keep paying $39 a month only until inertia expired. The churn rate had never been tested against a cohort whose hardware purchase was many months in the past, whose motivation had returned to baseline, and who was now comparing $39 a month to a reopened gym membership. The first public warning came not from the balance sheet, but from a federal agency. On May 5, 2021, the U.S. Consumer Product Safety Commission and Peloton announced a recall of the Tread Plus treadmill following one child death and more than 70 reports of adults, children, and pets being pulled under the machine. The CPSC's preliminary alert, issued 18 days earlier, had described the product as posing serious risks to children for abrasions, fractures, and death. Peloton had initially called that alert inaccurate and misleading. The company eventually agreed to the recall and took a charge against earnings. That same summer, demand began its permanent reset. Vaccination rates climbed, gyms reopened. Peloton had already committed to purchase orders sized for continued pandemic growth. By the end of calendar year 2021, the company was carrying approximately $1.25 billion in inventory. Consumer demand had moved on. The inventory had not. In January 2022, a document obtained by CNBC showed Peloton was planning to halt production of its connected fitness products due to declining demand. The stock fell more than 24% in a single day. Co-founder and CEO John Foley called the report misleading in a note to company employees. Weeks later, Peloton confirmed it would pause production. The production halt confirmed what the balance sheet had been indicating for quarters. A new CEO was about to be called in. But the production line was not the problem. The subscription model was. On February 8, 2022, Peloton announced that John Foley would resign as CEO. Barry McCarthy, the former CFO of both Spotify and Netflix, was named his replacement. The same announcement disclosed a restructuring that would eliminate approximately 2,800 positions, roughly 20% of the corporate workforce. McCarthy's appointment was read as a turnaround play. He had navigated Spotify through its post-IPO volatility and understood subscription economics at scale. What he inherited was not a straightforward turnaround. It was a business whose fundamental unit economics had never been validated under steady-state conditions. The Q2 fiscal 2022 earnings release, filed as a Form 8-K with the SEC on February 8, 2022, reported a net loss of $439 million for the quarter ending December 31, 2021. This was a quarter that ended before the production halt announcement, before the CEO departure, before the formal restructuring. The losses had accumulated before any of those events became public. The fuller picture emerged in the fiscal 2022 annual report. For the full year ending June 30, 2022, Peloton recorded a net loss of approximately $2.8 billion. Connected fitness hardware revenue had declined from approximately $3.15 billion to approximately $2.26 billion. Subscription revenue held up in the short term, but only because the existing installed base had not yet churned through at the higher rates that were accumulating. Here is the mechanism. Peloton's subscriber acquisition required hardware sales. When hardware revenue fell by nearly $1 billion in a single fiscal year, not only did current period revenue fall, the pipeline of incoming new subscribers dried up entirely. The installed base continued generating subscription revenue only until it churned at rates faster than any new cohort could replace it. At 0.73% average monthly churn against a static or shrinking subscriber base, the math compounds in one direction. McCarthy moved to break the dependence by decoupling the subscription from hardware. Peloton launched an app-only subscription at $12.99 a month, removing the $2,500 hardware requirement. Hardware prices were cut. The intent was to grow the subscriber base through pathways that did not require a large ticket purchase decision. The trade-off was structural. The hardware sale, despite its high cost, carried better unit margin than the lower-priced app tier, and removing the hardware incentive further compressed the market for the bike itself. Full-year fiscal 2022 also produced an inventory write-down of approximately $181 million. The purchase orders placed with optimism in 2021 became a balance sheet problem by 2022. The company had scaled procurement to match demand that had permanently reset lower. In May 2024, Barry McCarthy stepped down as CEO. Karen Boone and Chris Bruzzo were named interim co-CEOs. The company had narrowed its losses and shown progress on cost discipline, but subscriber counts continued their decline from the pandemic peak. The Peloton story is taught as a COVID overcorrection. That frame is not wrong, but it papers over the structural question the 10K filings were quietly answering throughout the same period the stock reached $50 billion. Peloton never demonstrated that its monthly churn rate could hold under steady-state conditions, with a static subscriber base and no pandemic forcing new hardware conversions. The subscription model had no independent floor. For anyone building a hardware-software subscription hybrid today, the Peloton annual reports are worth reading in full. Not for the headlines, for the footnotes on connected fitness churn, subscriber cohort retention, and the cost of acquiring a subscriber through a product that requires a $2,500 hardware purchase to activate. The business case was always conditional on perpetual hardware demand. When hardware demand normalized, the subscription model had nothing underneath it.